not going to be collapsing the banking system because then the bankers will get very upset. Instead, it will collapse the currency, and that will collapse the bankers because when the bankers have no more dollars and their dollar can't buy anything, and they have banks full of dollars, they have nothing, and then they'll collapse anyway. End of this, no matter where interest rates go, higher or lower, means the banking system is going to collapse. And when the banking system collapses, that means everything is reset. All valuations of everything will be reset to money and not to credit. And the question is, who will have the money? And that means, and the answer is, whoever has the gold and silver, they will be able to use their liquidity to acquire whatever capital remains, and everything will be redistributed based on who has the money and not who has the credit, because the credit will be worthless.
Gold and silver have lagged stocks for over a decade. But Rafi Farber warns that this is about to change as credit unravels and purchasing power shifts back into hard money. Rafi Farber underscores the underperformance of gold and silver compared to stocks, emphasizing that since 2011, investors who chose the S&P 500 have significantly outpaced those holding precious metals. For him, this divergence reflects a distortion caused by decades of credit expansion and inflated equity valuations, not weakness in gold or silver themselves. He argues that the true measure of wealth will not remain in paper assets but eventually revert to real money once the credit system collapses. Rafi Farber explains the distinct roles of gold and silver in such a breakdown. Gold serves as the ultimate preserver of wealth, maintaining purchasing power when fiat currencies fail, while silver provides the liquidity needed for everyday survival. Because all currencies are tied to the US dollar through central bank reserves, its collapse would trigger a global fiat breakdown, leaving only gold and silver as reliable money. Gold secures long-term stability, while silver's divisibility and practicality make it the essential tool for daily exchange. Rafi Farber concludes that this dynamic will soon tilt back in favor of precious metals. He expects that holders of gold and silver will ultimately regain far greater purchasing power than stock market investors, particularly as the credit system unravels. This shift, he warns, will mark the end of stock market dominance and usher in a return to real money as the standard of value. If you found this video helpful, don't forget to like, share, and subscribe to stay updated. We'll continue delivering sharp insights and expert perspectives on the forces driving gold, silver, and the broader financial landscape. Thanks for watching.
I dispute and I reject what you just said. Gold and silver have not been performing well at all. Not at all. They've been horrible, and they're still horrible. Because if you look at the valuation of gold and silver relative to stocks, if you just had a stock portfolio since 2011, so first of all, on a long term, since the 1970s, and also if you count since 2000, yes, gold and silver have both been performing better than stocks. Yeah, that's true. But they have not been performing well, and they're nowhere near, not even close to their tops relative to stock portfolios. If you have a guy and he just he has a 401k or whatever he has, and all he did was just invest in the S&P 500 ETF, and that's it, nothing else. Just kept reinvesting in that, investing his profits into that. He'd have a lot more money than if you invested in gold since 2011. So no, gold has not been performing well at all. Neither has silver. If you look at silver relative to the S&P 500, it's almost nothing compared to what it was in the 1970s. So silver has not been performing well. So if you look at the dollar number, yeah, it looks like it. But if you're gonna compare it to someone who has been investing in mainstream stocks for the last 15 years, it's been doing horribly. So I expect that to change very quickly. And once we see that gold and silver holders, those who have physical gold and silver tucked away somewhere and they don't have any stocks, once they can say they have more purchasing power than someone who's been reinvesting his dividends and his excess income into the S&P 500 for the past 15 years, once gold and silver holders say, you know what, we have all the purchasing power. You, the guy who has the S&P 500 or the Nasdaq or whatever, you've lost it all, and that'll be the end. So if that's what I expect to happen, so is there still time to own gold and silver and to participate in the rally? It's not really a rally; it's just a sucking of purchasing power away from mainstream stocks into money because of the death of credit. Yeah, there's time. Not much, but there's time. The reason for holding silver is very similar to the reason for holding gold, but it's slightly different. I'm pulling up a chart here that I can use to supplement what I'm saying. Hold on. So the reason to own silver is to get through the end of the currency system. That there's going to be a time when credit doesn't work, when you can't buy anything with dollars, and you're going to have some of a liquid commodity to use in order to get through it. Because otherwise, you'll have to, let's say, if you only have furniture and real estate, then you'll have to, I don't know, sell your house for, I don't know, 3, 4 weeks worth of food. That's not a good deal. Instead, you'll want something more liquid that you can buy a month's worth of food and you still have a house. That would be better. You'd survive, but you wouldn't have a house. I don't really look at industrial demand other than for silver. Actually, before we get to that, you asked the difference between owning silver and gold. The point of owning gold is to stabilize your purchasing power, but you're not going to be able to go around when the dollar doesn't work. And when the dollar doesn't work, no currency is going to work because all currencies are based in the dollar. This is just a mathematical fact because in the basements of all of the central banks, all the foreign central banks that issue other currencies, they are backed by US dollars. The foreign central bank, for example, of Israel, where I live, is the central bank owns dollars, and with those dollars, it prints shekels. And they try to balance that exchange rate between the dollar and the shekel. So they try to follow the Fed's monetary policy, print within certain ranges so that the exchange rate doesn't get too fakakta, messed up. And same with other countries. The Ukrainian, is it the hryvnia in Ukraine or something?
Yeah.
They do the same thing. So all other foreign central banks have dollars, and they try to keep their currencies within certain exchange rates, and the only reason they don't is because they're experiencing their own crack up booms, and they can't resist printing too much because otherwise their own banking systems will collapse. So they just go with hyperinflation instead. And so when that happens to the dollar, all the other currencies collapse with it. The point of gold is to stabilize purchasing power. And you're not going to be able to go around with gold ounce or even a half an ounce and buy retail amounts of stuff. You want silver for that. And that's where the purchasing power is going to be. So if you want to stabilize your purchasing power, you want gold just to sleep well at night, and you also want enough silver to actually get through the worst of the chaos, so that you have liquidity to spend on retail amounts of stuff, so you don't have to sell a luxury car for a few loaves of bread. You asked about the industrial demand. I didn't answer that question. So yes, there is industrial demand for silver. And back when it was the money directly, and that people used it as money, like but prior to 1873, when the dollar was taken off the silver standard, there was basically almost no industrial demand for silver at all. So in today's environment, we're talking about there is an industrial demand for silver, and there is no direct monetary demand for it right now. But when the monetary demand does reintroduce itself, there's still going to be that industrial demand that is on the side. So it's going to take some of the current silver supply and direct it into industry, so there will be fewer ounces to use as money directly when that is required, which will only increase its purchasing power. I don't know by how much because I'm not an expert in how much industry it requires silver, and if we're in a monetary collapse, how much of that industry is even going to be functional. I suspect not much of it in the immediate aftermath of the collapse, but as a credit system is rebuilt, I would expect that a lot of that silver is going to go back into industrial demand, and less of it will be available for monetary demand, which will help steady, I think, the purchasing power of silver. We saw in previous collapses, let's say 1980, when silver hit $50, almost immediately went back down. This time, I think it will hit a peak, and then it will gradually fall back down to some equilibrium level that will be less than the peak. But because of the industrial demand that will be reintroduced as the monetary system picks up again and we reintroduce an honest credit system, I think the fall of silver, which I do think will happen after a peak, will be a lot less pronounced than it was in 1980 or 1919 or those other years. Doesn't matter whether they should be lower or they should be higher, because what are you paying interest in? Again, you're paying interest in a unit that doesn't make any sense. So whether they should be higher or lower, they shouldn't exist, because a treasury is a vehicle to pay future dollars in dollar terms based on a dollar that's already existing because it bought a treasury. So you're talking about a self-reinforcing loop. The treasuries are units to pay future dollars, which themselves are treasuries, which themselves are dollars, which themselves are treasuries, and so on and so forth until the whole thing spirals out of control. So should interest rates be higher or lower? I know that these aren't like the answers that you wanted You wanted me to give, a number, what interest rates should be. Well, I mean, we could play that game. Let's say if interest rates are, let's say, 20%, what would that do? That would collapse the banking system. Well, if interest rates are 0%, what would that do? That would collapse the dollar. So it's one of those two. One of those two is going to happen. It's not going to be collapsing the banking system because then the bankers will get very upset. Instead, it will collapse the currency, and that will collapse the bankers because when the bankers have no more dollars and their dollar can't buy anything, and they have banks full of dollars, they have nothing, and then they'll collapse anyway. End of this, no matter where interest rates go, higher or lower, means the banking system is going to collapse. And when the banking system collapses, that means everything is reset. All valuations of everything will be reset to money and not to credit. And the question is, who will have the money? And that means, and the answer is whoever has the gold and silver, they will be able to use their liquidity to acquire whatever capital remains, and everything will be redistributed based on who has the money and not who has the credit, because the credit will be worthless.
Rafi Farber emphasizes that gold mining stocks, when measured against the S&P 500, remain near historic lows despite appearing strong in dollar terms. He warns that these stocks, while undervalued, are still dependent on brokerages and the broader financial system, which makes them unreliable in a systemic breakdown. For him, the collapse of the dollar, the foundation of all global fiat currencies, cannot be fixed by introducing a new paper substitute, since all currencies are derivatives of the same system. Once the dollar fails, no other fiat can survive on its back, leaving gold as the only viable base for value in a post-collapse world. Rafi Farber also points out that mining stocks carry unique risks depending on their scale. Majors are often weighed down by debt and systemic exposure, mid-tiers provide a healthier balance of production and growth, and explorers remain speculative and vulnerable to fraud. Yet he stresses that even these distinctions may lose importance once the credit system itself unravels. Whether interest rates spike to levels that break banks or fall to levels that break the dollar, the outcome converges on the same reality. The banking system collapses, credit is wiped out, and all valuations reset to real money. At that point, the decisive factor will not be stock ownership or paper claims, but who holds physical gold and silver, the only assets capable of preserving purchasing power through the chaos. Let's get back to the interview.
So here you see the gold stocks. This is the HUI index, right? HUI, it says HUI colon SPX. That means the value of gold stocks, of gold mining stocks relative to the S&P 500. So you can see here that gold stocks, right, and they hit a low in 2001, and then they hit a high of about it looks like 0.55, maybe 0.56 per S&P 500 unit. So here is where gold stocks hit their high relative to the S&P 500. This is where we are now, okay? Right here at 0.085, right? And this is a logarithmic chart. If we look on it on a linear chart, it's even more pathetic, right? You ask me, have gold stocks rallied? Or they're over here, right? All the way down, right? Yes, and they're very near a nominal high in dollar terms, but they're very close to the all-time low as they were in 2000. So no, they haven't rallied much. Am I interested in gold and silver stocks? Yes, I am. Not in terms of getting through the end game. I don't think they're going to be much use for that because they're going to be derivatives, and I own them through a brokerage, and I don't know what's going to happen to the brokerage, and there might be a great taking, blah 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 blah. But assuming we get through all that, I think that the purchasing power, once things start to stabilize again, I will be able to exchange my gold stocks for a lot of capital, a lot of purchasing power. Why? Chiefly, the simplest answer is that no company is going to be able to pay real dividends because they'll all have to break up as the currency system destroys itself. You have these humongous pieces of capital that rolled up and became these gargantuan companies because of the very inflationary system that is itself pushing up these valuations. And you have these trillion-dollar companies that will not be able to sustain themselves in a time when credit doesn't work at all. Except gold mining companies, what do they produce? They produce money. So they will be able to pay dividends. How? Through certificates for their own product that they will continue to mine. Power, the very thing will go up and will sustain their own business. So people that own gold stocks will be able to get dividends in gold and silver terms, not in dollar terms. Exactly how it's going to happen, I don't know. But each company is going to have to decide to figure out how to award its investors dividends in what way. If the dollar doesn't work, how is it going to do it? Maybe through paper certificates of their own product that you can go that I'm just speculating here. If you own, let's say, Newmont Mining and you have like one Newmont certificate because you own one share, then you can go to Newmont's desk or send it in by email. Here's my share. Give me my share, my dividend of gold, and then they mail it to you or something. I don't know. But there's thousands of ways to do it, but that's what I expect is going to happen. How are you going to do that? Like, okay, so they're in charge of a pyramid, and they're going to try to fix the pyramid by building it higher. Doesn't make any sense.
Oh,
The only thing you can do to replace a currency is by letting it die and then letting the market pick. If you're gonna say, okay, now you use this paper, that can only work in places where hyperinflation is localized, and there still is the base credit derivative with which to build off of. You could say to me, Rafi, you're not making any sense because in Weimar, that's exactly what they did. They replaced the Reichsmark with the Rentenmark, which is 1 trillion to 1, and then everything worked. Look at that, amazing. But this is different. This is a global hyperinflation that we're talking about because we're talking about the dollar itself dying, right? The Rentenmark worked because other credit derivatives were still alive, so you could reestablish an exchange rate with other currencies, which is exactly what happened to Israel in 1985. The shekel died. It's called the new Israeli shekel because the regular Israeli shekel died, and then they reestablished another credit derivative based on dollars. So it's the same thing basically what they did in the Rentenmark and any localized hyperinflation. But when you have the base currency of the entire global monetary system falling itself, then no other currency can be based on that thing that fell. You'd have to base it on gold, or it's not going to work. It's going to immediately hyperinflate again. So I'm saying after this pyramid dies, after this pyramid collapses, there's no way to rebuild it. It's done. That's it. Over. So they all have different forms of risk. The biggest risk with the majors would be that they're too big and they're going to have to break apart if the a currency collapse does hurt them because of some maybe futures positioning problem that they may have, or if they carry a lot of debt, they might be able to pay it off with product. But generally speaking, the majors they have negative economies of scale. They can't grow as much. So you do want to hold some amount of those because they do have some safety advantages. My favorite ones are the mid tiers, the ones that are producing, the ones that have growth prospects, the ones that have low debt. But they're producing not that much. Maybe they're struggling a little bit, but you can see they have active mines and they're producing a good amount of gold and silver. I would focus on those. Um, and the explorers, I trusted the people in charge, and I knew that they were very close to actually producing, but those can be very dangerous because, especially in an environment where everyone's bullish mining stocks, you can have all these charlatans popping up and saying, "Oh, buy this, buy that. We're going to have, 1 million ounces of gold in 2 years," and basically there's nobody there, and you don't know anything, and it's just marketing. Well, currency collapses do take a long time. This one has been starting since 1933, and what are we now? 2025, so we're like 92 years into it. It started in 1933 because that's when Roosevelt made it illegal for his citizens in the U.S. to own money, and he said, "You can only have my credit now, and I'll take the money." And that gave them that gave the central bank carte blanche to inflate the credit supply as much as it wanted, because without people being able to redeem their credit for money, they could control the inflationary system, and now we're year 92. So yes, currency collapses can take a very long time, as this one has. The question is, how much longer can it take? I think more than a few days. Do I think more than a few months? No. I think we're at the end. I expect that valuations will go up and down more and more in a more and more volatile way, because the unit on which they are counted and valued, which is the US dollar, is getting more and more shaky. So you'll see crazier and crazier rallies followed by crazier and crazier sell-offs, and this will get more and more and more volatile until the very unit with which we measure these things collapses entirely. So when you ask me about the valuations of stocks, um, my answer is nobody knows what the valuations of stocks are because the measuring stick that we use to value them is sick, right? If you're gonna tell me how far is it from my house to the nearest supermarket, and then you give me as a measuring stick something that keeps wildly changing, shrinking and growing, like wildly every second, I won't be able to tell you how far it is from my house to the supermarket. So any answer I give you won't make any sense because it can change the next day based on my measuring stick. All right, so there are no valuations of stocks. They're all an illusion. Everything is an illusion. Nothing makes any sense, and this is all going to hell.
gold and silver stand at the center of a collapsing monetary order, not as speculation but as the true distinction between money and credit. Unlike stocks or mining shares, which fluctuate with markets, physical metal remains the anchor that cannot be inflated away or erased by systemic failure. The dollar's unraveling, unlike past local hyperinflations, threatens every fiat currency, leaving gold to preserve wealth and silver to provide liquidity for daily survival. Mining companies, though risky, may endure by producing real money. Whatever governments attempt, the outcome is clear. Credit collapses, valuations reset, and tangible gold and silver prevail. If credit collapses and valuations reset around real money, how quickly could gold and silver reprice relative to stocks? And what signals would mark the start of that transition? Stay tuned for clear, data-driven insights into the financial system. Don't forget to like and subscribe so you never miss our weekly updates. Thanks for your support, and we hope you enjoy the video.